Let's take a look at the weekly here. Let's get back into our planning mode. Sorry for the tangent there. I think I spent about 10 minutes going over that. But here we are. We can see out of the last 19 weeks, only 3 weeks have closed near their high. So we have a very special week here. We can see, obviously, this is a bullish candle. The market's closing up. It's closing up into what was normally a resistance zone here. So there are a lot of reasons for us to plan ahead for a bullish move. But we need to be aware of this high price here. Now, these spike highs, I think, are very important because you have to ask yourself, during this week, why did this week here not look like this week? What happened in traders' minds to move the vast majority of traders to sell during that 1 week? Because remember, the market was moving up. Remember, it's moving up off of a low here. It's moving up here. It moved up to a high, and then all of a sudden, boom, it turned around. In fact, if we go down to the daily, and all this is very important, because remember, we're looking at how traders were thinking. Look at this daily bar. During this one session, the market just turned around on a dime and started going down. So let's go down to the hourly bar, and we'll scoot back all the way back. There it is again. And we'll look at the hourly, and look at this, even on the hourly. So in literally 1 hour, the market went from rip-roaring up to it's going down. That's very instructive. Now let's take a look at the time. And you can see, look at this. This is about the middle of the morning. So this could have been a news announcement. It could have been something hitting the market. And I would have to say that this type of reversal is definitely caused by some sort of news. Now, why is all of that important? Well, think about it. If there was some kind of news that caused traders to sell in the face of a huge bullish up move, then that information has to change in order for traders to continue to buy. It's that cut and dry. Because if traders' perceptions haven't changed, their buying isn't going to change. Listen, if your perception is that you just absolutely cannot stand men's baseball caps, and you say, you know what, I hate those baseball caps, I don't like the way they look, I'm never going to wear one, what's going to happen when you get one? Well, you're either going to give it away, you're going to sell it, you're going to get rid of it, right? But then if your thinking changes and somebody tells you, hey, you know what, there is a great market for these baseball caps, man. These people will buy them by the truckload. And if you put stuff on them like teams, football teams and baseball teams, they'll even pay more than they're really worth. Now what are you going to do? Well, when you get a baseball cap, not only are you going to think about keeping it, you might even think about keeping it because it's going to go up in value. Okay? The same type of thinking comes into play in any traded market. I don't care if it's Forex, stocks, futures, commodities, any traded market operates the exact same way. It's all about supply and demand. Now, why would there be more demand? Well, in the currency market, it comes down to fundamentals. It comes down to, is the Bank of England going to raise interest rates? Is maybe the Federal Reserve going to lower interest rates? Is the Federal Reserve not going to raise as many times as the Bank of England? There's a lot of things that can play into fundamentals, and that's why I don't really get into a lot of it because it can get very complicated. But just know this. The chart is going to represent the shift in thinking, and that's the whole point of this. What we are witnessing on the daily bar, I mean, look at the difference in the day. Okay, this day is closing near to the high. It's closing up. This day closed well off of the high. There's the midway point. I talked about that, I think, last week or the week before.